talking about opportunistic alpha generation in volatile markets. I thought we were actually going to be canceled coming into this week. For the previous 4 months, we had no volatility. So thankfully, we got a little bit of vol this week. And the goal of this panel is to discuss, some of the opportunities that our 4 panelists have ahead of them and ways in which they can take advantage of more volatility in markets. And we have 4 panelists today. Each, I'd say 3 strategies represented across the 4 panelists. But the common thread, I think, when you look across the different strategies is a focus on complexity. And I think that complexity has resulted over time in returns that are less reliant on traditional equity or fixed income markets going higher. So let's kick things off. I'm going to ask each of the panelists to introduce themselves, introduce their firms, and talk about their core focus in terms of strategies at the portfolios they run. Start with Andy.
Thank you, Robert. My name is Andy Ball. Thank you all for joining us. I work at a hedge fund called Westside Advisors. Westside has been around since 1998. We're a structured product-focused hedge fund, and we really have core competencies in a couple different areas. The first one is managing interest rate and prepayment risk in agency mortgage-backed securities, so that generally has low correlation to other asset classes and is really a yield-generating option writing strategy at the end of the day. The second is we put together an investor group to buy a bank in Connecticut a few years back and started an online lending program in refi consolidation student loans and mortgages. That was actually recently sold to KeyBank about a month ago. So we started up this refi consolidation program very similar to SoFi. We did securitization deals in 2015, 2016, 2017, and then the hedge fund retained first loss pieces on these deals and very high credit, very high quality credit borrowers. And so, we've operated in the structured product space for a long time. Our founder, Gary Lieberman, came out of Salomon Brothers in the 80s. And worked at Merrill Lynch and Bear Stearns in the early to mid 90s before launching the hedge fund. So been around for a long time. Really, work hard at trying to bring unique opportunities to market. In the agency space, we manage about $500 million, and then we manage another 150 to 200 million in these other refi consolidation student loan strategies and also CMBS.
Great. Thanks for having me. My name is Maggie Arvedlund. I'm the CEO and managing partner of Turning Rock. We are a special situations firm based in New York, founded by myself and 2 other former managing directors of the Fortress Investment Group. And what we do is really simple. We provide structured equity or structured debt to small and mid-cap privately held companies that are going through a period of transition. Oftentimes they hit a wall because their capital structure is a little out of whack, or perhaps they need to finance growth, or perhaps they have a shareholder structure that's misaligned, and that's where we come in. Our team's been together for about 12 years now, and we are a majority women-owned business, so that's kind of a different contour for us. And we also typically deploy about $10 to $50 million per transaction. So for any company founders in the room, love to talk to you after. And in terms of our approach to opportunistic alpha, I'm looking forward to the conversation. We see a significant opportunity now as the banks continue to be retrenched and companies need more bespoke, we think, highly customized solutions.
I'm Charlie Carnegie from Context Capital Management. We're a capital structure arbitrage hedge fund. We focus on convertible bonds. We were founded by my 2 partners in 2002, and I joined the firm about 4 years ago, or rejoined the firm rather, as a portfolio manager. So we manage a portfolio primarily convertible bonds, a bit of high yield, some bank loans and warrants, but the focus is really finding capital structures that are a little bit sometimes unusual or conundrums, we say sometimes, where companies are over-levered. Mm-hmm. Usually we find situations, or we try to find situations where there's sufficient asset value. May not be reflected in the balance sheet or certainly the income statement. A lot of these companies burn capital, so you can see a lot of companies these days in biotech, technology, software, and so forth that actually burn a lot of money, but that doesn't mean there's not a lot of asset value there. And some of these companies make the mistake of borrowing too much money, they have delays, they hit speed bumps along the way to growing into the great company they think they can become. And along the way, they become over-levered, and they have to figure out a way to normalize the balance sheet. So we really focus on that segment within convertible issuers and occasionally high-yield issuers. My partner's been in the business for about 30 years. I've been in the business for about 15, so we have a lot of relationships. It's the convertible market is fairly small and niche-y, and so we kind of have our space that we play in, and we stick to it, and just try to find opportunities to create returns with very low correlations.
Last but not least, Adam.
And my name is Adam Rilander. I work at Galton Capital. It's a part of Mariner Investment Group. We manage about $1.5 billion. We were founded in 2007. We focus on consumer and residential credit. It's about half agencies and half sort of non-agency type of risk. We have two main lines of businesses. One is the hedge fund business, which is, I would say at this point, about 80% of the assets. And then we have a mortgage conduit as well, which is about 20% of the assets. We're focused on sort of the redevelopment at this point of the mortgage market. We launched an agency strategy about a year and change ago at this point, sort of, again, to focus on where the next opportunity will be as the Fed starts to exit the mortgage market.
Mm-hmm.
Great. Well, thank you. Maggie mentioned bank retrenchment in her intro, so let's start there. Since the financial crisis, we've clearly seen banks step back in a major way from a number of different businesses. So, how are hedge funds like each of yours, or strategies like each of yours, able to take advantage of the void that has been left by banks no longer being in some of these markets? Mm-hmm. And in addition to that, let's talk about the volatility that is likely to occur or has occurred since the bank retrenchment occurred post-crisis, as well as the liquidity aspect, and what do you expect going forward and how it changes your strategy of managing your portfolios? Mm-hmm. We'll start with Andy.
So it's a little bit different in our space. The grandfather of all banks, the Fed, is actually taking a big step back from our space. This will be really the first time in 30 plus years where either the GSEs in Fannie and Freddie or the Fed is not buying agency mortgage-backed securities. Mm-hmm. And so I don't necessarily think the full weight of that has been felt by the market yet. Certainly the portfolio of mortgages, agency mortgages that the Fed still owns is still very large and will continue running off. But just the sheer fact that they will not be on a daily basis buying mortgages anymore means a lot for the mortgage market, especially when we talk about convexity, and if rates were to drop significantly, such that we got generational lows in mortgage rates again, not having the Fed there to buy or the GSEs, Fannie Freddie to buy, is going to create, I think, a lot of opportunities, right? So in the Fed, you had a non-economic buyer who was there compressing spreads everywhere. With them out of the market and the GSEs out of the market, you do, I think, create more opportunities over time to both be long and short mortgages. And it's a great asset class because you can actually be long and short over time. So when you look at a long-only agency manager, they can't necessarily take advantage of that, whereas as a hedge fund, we're really able to take advantage of mispricings in this, it's a giant market, it's $5.4 trillion. Agency MBS. So we're looking forward to days where there is no longer this non-economic buyer in there all the time.
Mm-hmm. Mm-hmm. So I would echo similar sentiments. So what we do really well is arbitrage the dearth of bank capital, particularly in the small and mid-cap corporate space today. And really, as you've seen, actually I went to a SkyBridge event and they showed some great charts about dealer inventories being down. Also prop capital. So our former firm, we used to fill that void, right? And we used to provide that alternative capital. And today, a lot of the bigger hedge funds have moved up market. So they're generally deploying, 100 to 250 million per credit, per trade. So what we try to do is arbitrage the dearth of not only bank capital and the, decline in liquidity on the dealer desks and prop capital, and go directly to the companies. And in doing so, we can extract alpha. On the volatility side, I think that's a really important point that we should cover here today. A lot of the non-bank or direct lending market today has tried to fill that void, and in my opinion, it's primed for disruption because many of the underlying asset term liabilities just don't make sense. You have $600 billion, close to $1 trillion in private debt funds. You have the BDC markets. We have, in the mid-market, I don't know if anyone's following it, as of yesterday's close, you have leverage through the senior close to 6 times. The last time we were at that level was the first week of August in 2007. And I remember that week specifically. Now, I'm not calling for a similar cycle in the next, year to 18 months, but I think it's prudent to mention that a lot of the leverage that has filled this void has been largely predicated on cash flows, not assets.
Yeah.
So very important to differentiate kind of the weak form versus the strong form. So we share that view. We focus on companies that have definable cash flow, that have recurring revenue, that have contractual visibility for us, and also a fair amount of asset coverage that can support our credit instrument or our equity instrument. So I think the volatility could really create a rout in both the subordinated financial markets here, alternative capital, the BDCs, and others. So that's a very interesting dynamic right now.
Yeah, so we see a lot of those same dynamics. I think also when we talk about banks pulling back from some of these markets, we think about capital. We talk about Dodd-Frank and Volcker rule and the cost of capital they have on the desk, and it doesn't make sense to run a lot of these trades, particularly relative value like convertible arbitrage and some of the stuff that we look at. But in addition to the capital getting pulled back, what's lagged a little bit is that they realize, well, if we're not deploying capital, we can't expect the same profits. If we can't expect the same profits, we can't employ so many people on these desks. So just in the last 3 years, we've seen convertible desks shrink significantly, even forgetting the last 10 or 12 years. So the number of personnel is down significantly on the sell side. They need a couple core traders, they need a couple core sales guys, so there are no analysts. There's basically no training taking place. So traditionally, a lot of the great hedge fund managers and analysts started as analysts on the sell side, learned the craft, and then moved over to the buy side. There's not that pipeline of opportunity, or of talent rather. And so there's a lack of capital, there's a lack of expertise, especially fundamental expertise, and it creates a lot more dislocations. So we see in terms of liquidity, there's liquidity in the markets, but it's spotty. So at our size, we view that as an advantage because when there are greater dislocations driven by larger mutual funds and hedge funds selling or buying a security, we can take advantage as a smaller, more nimble fund of those dislocations. And then also on the volatility point, I think that recently people were talking about how low volatility was. Obviously, that's changed the last few days. But Jeffries put out a great note a few days ago about, before volatility spiked, about how actually if you measure it on a monthly basis, volatility is extraordinarily elevated. We're getting 4 or 5% moves on a monthly basis. On a daily basis, it's very low. And so what that tells me is that there's serial correlation one day to the next. If the market's up one day, probably better than a coin flip, it's going to be up the next day. And if it's down one day, more than a coin flip, it'll be down the day after that. And I think that might be a little bit resulting from banks pulling back from intermediating markets where when you have more buyers than sellers, you can't clear the market in a day. And so it can take days, weeks, months, and it looks like Maggie's nodding her head here, where especially the securities that we deal in, if you have a big seller of one security, it could take them 3 weeks, 6 weeks to get out of some of these positions. So it's not a coin flip the next day whether these bonds are going to be up or down. And that provides more opportunity for us to add trading alpha to our fundamental alpha and to find better opportunities to enter trades and to exit trades.
And lastly, so I do something similar to what Andy does, and I think that he's right on the Fed exit and how that's going to present a large opportunity. I would say that really there's a big difference within the agency space about day-to-day trades versus sort of monthly or yearly trades, which is there's still really good liquidity on the street for things that they can get in and out of within minutes or hours. And so if you think about agency mortgages, you can sort of trade those extremely liquidly right now. But if you compare that to some of the other less liquid products out there, either agency IOs and inverse IOs, or even as you go into some of the even less liquid products than that, reverse mortgages, project loans, you can sort of find that there are much larger dislocations that can happen. That's I actually think that a large part of what drove the sell-off in December was sort of this lack of capital, and you sort of saw it start in the agency market where dollar rolls were trading worse than funding, and the first time that had happened really since 2009 or 10. And so there just wasn't enough capital to buy the assets that were needed. Banks were sort of stepping back due to Basel III and their one-time rules that happen at the end of every year, where they get a one-time snapshot. So sort of on the big picture and how much capital is available, you're going to have these moments where there's just not enough capital to buy things, and there's going to be really large opportunities. But on the day-to-day basis, you can still find sort of ready liquidity if you need to within the agency mortgage market.
Great. Well, I know none of you firms are macro firms, but let's turn to rates for a bit. We, again, fortunate, we got yield curve inversion again today, 3 months to the 10-year. How do rates and an inverted yield curve impact your strategies, and what can you do to take advantage potentially of an inverted yield curve? Well, let's start with Adam this time. We'll go at the far end.
So I think that, to be quite honest, within the agency mortgage market, I think that we can be fully hedged on the rate side. I think that part is, I think we can hedge out all the curve components, everything else. I think that where the real opportunity set that's sort of showing up is, as this is pointing towards, if this is pointing towards a recession, that's sort of the greatest environment that you have for the agency mortgage market. This is one of these rare products that's sort of uncorrelated. If you look at what happened over the last year within IOs and inverse IOs, you actually saw that one of the worst things that happened to the market was the fact that the home prices were up so much, so you could take a lot of cash out of your home, and refinancing is actually surprised to the fast side. If you were to see a recession, I think that would be one of the greatest opportunities within the IO and inverse IO market. Refinancings would surprise to the slow side, which would be really nice. You also would start to see really good opportunities. Mortgages would be likely to widen, and you'd see a lot cheaper IOs and inverse IOs. So I think that that's something that we're looking forward to if that happens.
Yeah. Similarly for us, the curve itself doesn't matter all that much unless it's doing something really crazy. But what's interesting is what that represents. And what it represents is that the bond market is forecasting very low growth going forward. And where we find a lot of our opportunities is companies that expected very high growth, and they borrowed accordingly, and that growth doesn't materialize. So the more difficulties that companies like that have along the way, the more opportunities there are going to be for us to look at. And so, we've seen in our market, even recently with the equity market rallying back so much, there's been a huge lag in CCC credit. There's been a huge lag in unrated convertible bonds. And some of the newer, smaller financings that come out are coming cheaper than they had been a year ago. So we're already seeing a bit of a repricing as I think investors look towards a future that's probably a lower growth environment. And the less growth we have probably means we're going to have more volatility. And it's going to just create more opportunities.
Look, I think the yield curve issue is top of mind. How we handle it tactically, right, is to keep most of our obligations floating rate. And we also think about the demand of that capital, right? So we have a trade deal on deck here. We have inflation concerns. We have, real concerns for company owners of how they're going to finance growth. And this is where we spend a lot of time. So for us, keeping it short duration, and I know this is the topic du jour of this conference, but basically we don't want to be long duration in this market. We want to keep generally 36 months and in. And at the same time, we want the downside protection, right? So there's this constant trade-off here. But I think you
do have the benefit of long duration capital. But you're saying at this point in the cycle, you'd rather keep your deals that you do on shorter duration.
Correct. And I think it's also about the term structure. So if you're allocating capital to a manager or to a trade, make sure that their liabilities are properly financed and make sure that your capital, matches up with that. So for us, we've got 5-year term capital, and that allows us to weather through periods like December where the markets were, out of sync.
Great. Andy?
So what we do in the agency mortgage market is basically take internally levered prepayment bets. So these IO and inverse IO securities that Adam was talking about are basically very levered ways to bet on the level of prepayments and the level of rates and the shape of the curve. And the reality is these trades generally do poorly when the yield curve is flattening, and they do very well when the yield curve is steep. And that's not unusual for carry trades, and this is basically an internally levered carry trade. And the way we sort of think about our product is we have, in order to put on a yield curve steepener today, it's actually about negative 25 basis points on an annual basis, right? So it's costing you money to put on this duration neutral long to short tens trade. And people want to put that on because they're hedging against a recession, right? So if they don't want to short credit or they don't want to go short the S&P, they can say, okay, as a portfolio hedge, what I'm going to do is I'm going to put on this curve trade because if the economy is going south, then the Fed's probably cutting rates, and that's going to be good for me. Well, the product that we manage allows you to put on that yield curve steepener effectively. I mean, even if you're hedging all your interest rate risk, the product itself is still going to do much better. You're still going to get more interest income, more carry when the yield curve is steep. And so you're able to put on this yield curve steepener and actually a positive carry trade, right? So, the yield on the securities today, even when the yield curve is flat, is about 6% on sort of an unlevered basis, which goes up pretty substantively if the curve steepens out in 2s, 10s, and you get more high single digits, mid-teens if you get that 100 basis point steepener event. So you got a positive carry trade. You're putting on a yield curve steepener. It's got a negative beta to sort of the overall economy, which I think makes a whole lot of sense to folks. But it's tough because you're basically short convexity the whole time. So you have to manage this short convexity trade, and it's been tough. It's been tough because the Fed communication has been all over the place in the last 3 months, 4 months. First, rates were at 10-year was at 3.25, headed to 4%, and now suddenly we find ourselves at 2.50 on the 10-year note, and so it's a big change in feeling. And actually, the rightly or wrongly, the president has been, I think, very smart about what he's doing, because even if he doesn't get a trade deal or has to play hardball with China, I think he set up the Fed to be able to cut in a lot of circumstances where growth maybe surprises a little bit to the downside. And so we, from a positioning perspective and just a more macro perspective, maybe the curve doesn't steepen next month or next quarter, but that steepening, I think, is going to happen, whether it's a bull steepening because the Fed is forced to cut, or a bear steepening in where we get a trade deal and growth actually starts picking up more globally, and you actually start getting some inflation follow through. So, at 15 basis points, 2s, 10s, and some of the curve inverted, it certainly may invert more, and we certainly have on our curve hedges against our position. However, at some point, it's going to make sense to take a lot of those off, I think.
Yep.
And so that's sort of how we think about the macro picture in our strategy.
Great. So Charlie, context has been around since well before the financial crisis. You've survived a space where many of your competitors have gone away. You've thrived post-crisis. What's changed with the convert market? It seems like there are very few players. When we look at our peer groups, there's Context, a couple other managers, and that's about it. It used to be a bread and butter hedge fund strategy. So why do you think there's a lack of competition right now? What's really changed in the market? And where do you see the best opportunities? And maybe give an example of something in your portfolio or a recent successful trade.
Sure. So the convert market sort of has this long history as one of the original 2 or 3 hedge fund strategies because it's a naturally hedgeable instrument with an embedded call option in the bond. And for a while, it was frankly just probably too cheap, and there weren't a lot of hedge guys. So the more bonds they bought, the more money they made if they were hedging them up. And that evolved into more of an arms race on the quantitative side, trying to develop quantitative tools to measure exactly what a bond is theoretically worth. And there was a bit of an arms race there in the 80s and 90s. And then in the 2000s, the quantitative side got largely commoditized. You can get a web service for a monthly fee and basically model up the securities as well as anyone else in the business. You need obviously some mathematical expertise to understand the model, but you don't need to spend decades developing it. And at that point, everyone just decided to use more leverage, which worked until it didn't with the crisis. And post-crisis, there was a drop in issuance in convertibles for a while, which now has started to come back. It's roughly doubled over the last 3 years. But in addition, the large funds grew, or the very successful funds grew too large for the asset class. It's a $300 billion asset class. It's not sufficient to run a multi-billion-dollar firm. So the biggest ones now have added other strategies and branched out into credit more broadly, or distressed or activism. And some of the mega multi-strats, like Citadel, started in convertible bonds, and they branched out long ago. And then the less successful funds haven't really grown or survived in the recent hedge fund market, that I think is a little bit more choosy with hiring and allocating to managers. So we've managed to find the sweet spot where we've had good returns, but we've stayed small and stayed focused on our particular strategy in a focused manner. It's really a subset of the convertible market. And I think by really focusing on that and not branching out and not using a lot of leverage, we use less than 1.5 times gross leverage. We have some of our peers run 3, 4, 5 times. So that has helped with some of the volatility that we have, just that we're always in a position of strength from a capital standpoint. But we continue to find a lot of opportunities, and actually probably more as there is less competition. So I give you an example on a no-names basis, just because I don't want to be the guy talking about a relatively smaller company like I know everything. But we have one position where the bonds are due in 3 years. They trade in the 70s, north of 15% yield to maturity, less than 3 times levered. And there's $1 of public equity market cap for every $1 of net debt. So we have a significant market cap that we can hedge into. We think there are catalysts where these the bonds might return a lot more than 15% in the near term. We've encouraged the company to do an exchange, and whether they listen or not is probably 50-50, and we're not the only ones telling them that. But there are ways to make even more than that on the long side. And on the short side, this may be another case of a company that we find many of where the equity is really not going to do much over the next 3 years. In fact, it's likely to go lower, because for this company to address its debt, they ultimately might have to dilute their equity. And to the degree they dilute their equity to pay back the debt, we'll make money on both sides of the trade. So it's not a traditional convertible arbitrage trade. It's really a fundamentally driven capital structure arbitrage trade. But we find a lot of these in the convertible market with public market caps that we can hedge into.
Mm-hmm.
Great. Well, let's turn to Maggie. How has your firm taken advantage of some of the inefficiencies in the smaller cap space today? And can you perhaps give us an example of how you structured a deal, how you sourced it,
Sure.
and where the inefficiency was?
Yeah. So first things starts with market cap, right? So we agree that the small and mid-cap space offers more opportunity. They're less covered by the street. They tend to be less intermediated, right? They're not calling up Goldman Sachs, no offense to Goldman if anyone's here, but they're not running a process. So let's start with that, subset. Then 2, we look for companies that have, that really operate in the sectors where we invest. So transportation, communications, business services, generally sectors that are less cyclical, less sensitive to overall market declines, and generally, take advantage of consumer or pretty stable business demand. We do not invest in the growers. They're kind of the slow-moving companies, right, that generally grow between 3 to 5%, but that have embedded rent escalators, right, to their end customers. We also look for companies that have more rated obligors, in the sense that they sell into a much larger cap space. So for example, one of our biggest positions right now is a fiber and communications company. It's based in Miami. So all of us on our phones all day long, all of that data lands from wherever it's pinging, comes on site to Ashburn, Virginia, Miami, San Jose, and then it needs to get transmitted out. So one of our core positions is actually a company, it's basically like a tolling station. Doesn't matter what markets are doing. The data needs to get to the end customer. And we've got Microsoft, Yahoo, Verizon, T-Mobile, all as customers under 5, 10, 15-year contracts. That's a classic Turning Rock position. And on that one, we structured a senior secured term loan. So it was a 3-year ABL secured by physical assets, fiber, communications, inventory, and equipment. The replacement value of that would be 3 times our basis. And then we also did a convert. because we know that there's a bonanza. If you saw the news about Zayo yesterday, or 2 days ago rather, the secular demand trends for data and communications, we're all addicted. But beyond that, it's corporates are spending more because we have 5G, we're going to have 6G soon, and beyond that, we need safe and secure. So we play sometimes in both parts of a capital structure. But in all cases, we need to be downside protected, and I agree, you've got to go to the places that the banks aren't playing or that aren't intermediated. And in doing so, we think we can create a very unique return stream.
And where the ETFs can't play since they have all the money.
Right, exactly. There's a cannabis ETF apparently now. This is a new frontier. Right.
Let's go to Adam and Andy. So agency MBS with an RV orientation typically makes people's heads spin. Very complex space. I think what you're ultimately trying to take advantage of are pretty big, broad themes in the housing and mortgage market. So for the audience, can you demystify the space? You've done a little bit of it already. But talk a little bit about some of the opportunities that exist for a hedge fund versus a long-only shop. You did kind of hit on that already, but I know there's a lot more out there that you could discuss. And really what you're trying to take advantage of today based on where rates are and what the housing market looks like. Start with Adam.
All right. So, so the hedge fund versus long-only approach, I think there's a few key ways where it's different. And number one, simply right now, it sounds like Andy and I think a lot of people have this sort of similar view that the Fed exit's going to be a big deal. So going short an asset is sort of unique in a large liquid fashion, so you can go short agency mortgages very readily, and it's very easy. So I think that is certainly one approach. And I think the other part that's really important is in this IO and inverse IO sector, if you're a long-only manager, there's really very long or very negative durations in both IOs and inverse IOs, depending on which one you're focused on. So from a money manager standpoint, often you might find bonds that look interesting, but you can't buy them because the duration really isn't a fit. But from a hedge fund standpoint, it's very easy to use some of the tools available, such as going short Eurodollars or buying either treasury options or other forms of volatility if you feel like you like the risk, but you don't want the negative convexity or the negative vega that's associated with it. So I think you really have a lot of instruments that are available to you if you're going to take advantage from a hedge fund side, and it's much more difficult from a long-only side. I also think a lot of the long-only managers end up making assets sort of inefficiently priced because they sort of want them for different reasons, such as buying IOs, which have a negative duration. Often they get rich when the world takes an opinion that they want things that are going to go up in price when rates rise.
Yeah, nobody gets up in the morning thinking about prepayment risk. I'm probably the most boring guy at a dinner party. Nobody wants to talk. Everybody thinks they understand credit, and that makes a ton of sense. You're making a loan to somebody. Are they going to pay you back or not? Do they have the ability to pay? Do they have the willingness to pay? But prepayments is sort of this thing that strikes people as, what is this? As I was saying, the agency market's a $5.4 trillion market. And our strategy is really, at the end of the day, and I sort of alluded to this at the outset, it's an options writing strategy, right? Because we're writing an option to the homeowner that they can refinance their mortgage at any point in time. And there's some frictions that keep them from doing that, right? So there's some costs associated with refinancing. It costs anywhere from $3,000 to $5,000, depending on sort of where you live. But the reality is homeowners don't exercise that option efficiently. And so, there are still people out there who originated their mortgage in 2003 and pay 6%, 6.5%, where current mortgage rates are 4.25%. And, that exists because, maybe they're on a fixed income and they don't have the, cash on hand to be able to refinance. Maybe they can make their payment and they really don't care. Maybe they don't know about it. I mean, we're all a lot of people are finance people, and so they're spending all their day sort of thinking about arbing, their mortgage, but a lot of people out there don't. And so when we think about being short convexity or writing this option, we can write this option to the homeowner, and then we can go hedge that option in rate space, all right, where we can actually buy back convexity that we think is actually cheaper than what we have in the mortgage space. So there's a lot of those sort of arbitrage opportunities where we can pick things that we think are mispriced from a prepayment perspective, but also from a larger macro perspective, we can write this option and collect that premium, and then hedge the interest rate risk in liquid markets.
Great. Well, look at that clock. We're almost at 0. So with that, I want to thank everyone for coming today and encourage you to reach out to the panelists. Very interesting strategies. Obviously, at a time in markets where, buying equities at this point in the cycle, it's a tougher thing to do. And these are strategies that are lower beta. Traditional fixed income's been very challenging. These are some strategies you can add to your portfolios in your fixed income book and generate, pretty attractive uncorrelated return streams. So I encourage you all to reach out to these people.
Thank
Thank you.
Thank you.
Thanks.